everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 242 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about your investing, and specifically investment habits that you need to break. If you have these specific habits in your investing life, you need to break these habits because these things can be detrimental to your long-term financial health, and they can be detrimental to your ability to make good investment returns into the future and allow yourself to grow your money in an adequate way in order to reach long-term financial freedom. So I really want you to take heed to some of this advice that I'm going to give today, some of these things that I want you to steer clear of and fix them if these particular habits are present in your own life. So stay tuned for all that and more in today's episode. So before we get started, though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental material to all the things that I'm putting out on these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Then just DM me on any of the major social media platforms at MNO with Dylan and tell me that you are interested in financial coaching sessions, and you and I can begin working together in creating financial goals that are specific to your life, and then pushing towards ultimately long-term financial freedom for you and your family, whatever that may look like in your specific situation, because that's what I hope for every single person who watches or listens to this show on a daily basis. Now, for many of you out there, investing is either something that may be new to your life, or investing is something that you do and maybe you don't know a lot about, or maybe you've been doing it for a long time and you just are building some bad habits that are things that are maybe keeping you from getting to your long-term return goals. Maybe they are keeping you from doing the things that you wanted to do long-term with your investing. And I just want to help you no matter where you're at in your investing life, whether you are new or whether you've been around the block a few times, because both of those categories, new or experienced, these individuals can still have bad habits, right? And those bad habits can definitely look different. And some bad habits of the early investor may be habits of, not having a good financial plan, not having a good idea of what they're invested in, things of the like. But the experienced investor, they may know what they're invested in, but they may have become indifferent to some of the things that you should be taking into account when you're making investment decisions, and yet they are not. So we're going to talk about 10 different investment habits that you should break in today's episode, okay? And so we'll start with the first one. The first one is short-term thinking, okay? You should think long-term with your investing, always. Okay, short-term thinking gets people in trouble, and I think there is, some very telling statistics on the ability to grow money over the long term with your investments, but the inability to grow your money in the short term on a reliable basis. Now, do not get me wrong. Over any short period of time in certain asset classes and certain investments, right, you can make an absolute killing. All right, but if you are just making that short-term killing and then trying to move on to the next thing and try to make quick returns and just move on as quickly as possible from asset to asset and trying to get quick returns, you're going to end up getting burnt eventually. All right. There's something that I teach in a college finance class, and what I teach is that the longer that you hold a particular portfolio. Okay. So I show, a 100% stock portfolio, 100% bond portfolio, 50-50, and then, kind of everything in between. And I show that the longer that you hold any one of these portfolios, right, the mean, meaning the average return that you could receive, that doesn't necessarily change. Obviously, you take a long-term mean, that mean is not going to change, right? But if you just held a portfolio of stocks over a 12-month period, right, the returns you can get to the upside could be fantastic, but the returns that you could get to the downside could also be fantastic, right? But if you continued holding that same bucket of stocks, that same group of stocks, and you held them for a year and then 2 years, 3 years, 4 years, 5 years, right? Well, from 1 year to 5 years, the standard deviation, right, or the variation in the returns that you could have received, it really tightens, right? You start getting to where most of the returns that you would have received were positive, right? And the difference between the most positive return and the most negative return really tightens, okay? And then the further out you go to 10 years, then that tightens even further, right? So holding investments longer, right, having a long-term viewpoint for your investing can allow you to take some risk off of the table. And that's what I would like for you guys. I would like for you to have long-term viewpoints to take risk off the table and to allow yourself to stick around for some of the long-term returns that you can get. If you are very short-term oriented when it comes to your investing, right, then you're going to miss a lot of returns. And you're going to do a lot of speculating and not a lot of investing, meaning you're going to just look at the price of things and try to get in at this price and get out at this price and worry a lot less about the fundamentals of what you are invested in, which has been proven time and time again to be a big mistake. Okay, so short-term thinking is something that you should break if it is a habit that you have when it comes to your investing. Then, the second habit that you should break is herd following, okay? Meaning, if you are following your friends and if you're following everybody that you hear on the street that is buying Bitcoin or that's buying Tesla or that's buying Apple or that's doing this or that in their investment life, then you are likely to lose, right? Normal is broke. I've told you that many, many times. And I tell you that in terms of debt and, what people do with their income. But normal is also broke when it comes to your investing, right? The normal individual is going to underperform the market and underperform the market by a pretty substantial clip. The average individual, I think, underperforms the market by like 1.5%, right? When that's not necessary for anybody to underperform the market by that much, because you can just buy the market. You can just buy these stock index funds that just track the market. So there's no reason to underperform by that much, but people do. And one big reason that people do is because they follow the herd. And a lot of that herd following comes from the fear of missing out. People have this real fear that if they aren't invested in what their friends invested in, especially if their friends make some good short-term returns, right, that they're going to miss out. And so they just follow the trends, follow the hot things. And what ends up happening is if you just, follow the hot things, you end up buying at some unreasonably high prices and then very possibly selling for losses because you got into whatever investment it was at a time that was later than was conducive to making good long-term investment returns, okay? So herd following is a big issue. And then the third investment habit that you should break if it is a part of your life is not sticking to a plan or even having one in the first place, okay? If your investment plan is to put money into your 401k or your IRA into an S&P 500 stock index fund and just continuously feed money into that account and that particular investment and just feed it forever, right? If that's your investment plan, great. Stick to that plan, right? Do that, okay? Do what you have already planned to do. Do what you have set out to do with your investments. What you don't need to be doing, and this kind of goes back to herd following and that short-term thinking, right? You don't need to look around and think that somebody else just has such a better plan, right, without some long-term track record, because that's something that a lot of people get caught up in is they'll see that somebody made 100% in a year, 150% over the course of a year, but they don't ask that person, what have you done over 5 years or 10 years or 20 years, or right? Investing is a long-term game. Right? If you see where somebody like, let's say, Kathy Wood, who runs the ARK Invest ETFs, and she is the chief investment officer, and she makes all those investment decisions into all the growth stocks, right? In 2020, that was very lucrative. That was something that made a lot of return, right? And that made a lot of investors just jump into her funds. And then a lot of investors jumped out as the tech trade began to kind of wane, and the price of particularly the ARK Innovation ETF really fell hard. And so somebody like Cathie Wood made really great returns in the short term, and she expects to make great returns over the long term, but she hasn't proven that she will be able to do so. Okay, and so if we're just following people that have no proven track record, then that is something that is enticing to us. It's enticing to us to find somebody who has some short-term success and then jump from our plan to theirs, right? But if you have a good plan, and if your plan is based in statistical fact, if your plan is based on fundamental value and something that has worked historically and will continue to work over the long term, then stick to your plan. And if you do not have a plan for your investing, then you need to create one. You need to write down exactly what you are going to do in your investing life. Because if there's no plan, if there's nothing that is binding, nothing that is going to keep you moving in one direction and not another, what's to say that you can't just pick up whatever you're doing, scrap it and do something else. Okay, so you should always have some written plan as to how you are going to invest your money, and you should stick to that plan. The only reason you shouldn't stick to an investment plan is if it doesn't work over an extended period of time, or two, you find out that there is a material reason that that investment plan does not work, and there's something else that you should be doing investment-wise that actually is a wise thing to do, and not something that is maybe rooted in short-termism or rooted in not making good long-term returns, okay? So you need to stick to a plan if you have one, but you need to have a plan in the very first place, all right? Then, the fourth thing that if you have this investment habit, you should break it. That is relying on past performance. And this is specifically when we are talking about active investment managers, right? I've told you guys time and time again, the active investment managers on average underperform. They underperform the market. And if they are underperforming the market, what that tells me is that a bunch of people, right? A bunch of individual investors, they flock to mutual funds and to ETFs that do have good short-term returns. They have this short-term thinking, all right? So they flock to these mutual funds and ETFs that have good short-term returns, and they believe that those returns will last into the long term. Well, a big problem that a lot of people don't see until it is absolutely too late is that when there was very little money to invest for an active manager, it was really, really easy. They could just put that money to work in the way that they wanted to put it to work. They could grow the money well, and they could outperform the market. But then, over time, the fund gets really big. They have to become less risky in order to, just kind of keep up with market returns and keep investors appeased and keep the cash inflows coming and not have too many cash outflows, right? And when that's the case, then past performance can wane. So especially with active managers, and especially in a situation where you're not just index fund investing, right? Don't just rely on the past performance of a particular mutual fund to tell you exactly what you should expect into the future, right? And I say this especially in the short term. If you can find a mutual fund that's, had a sustained, 10, 15, 20 years where it has averaged a good return, right? It's averaged a really good performance, then there's a high likelihood that that's going to continue into the future, right? Because it's hard to sustain success in that particular way. That means they likely have a good investment philosophy and they invest your money well, okay? So relying on past performance is very dangerous, especially for active managers. But if you are indexing, then relying on past performance is something that can really help you to understand what your future returns should look like. Okay, so you should look at past performance, but just don't rely on it as a means to determine what future returns are going to be, especially when you have some person that is actively managing your money and is actively getting more and more cash inflows because they seem to be so good at investing money, especially in the short term. Okay, so be very wary of past performance. Then the fifth investment habit that you should break if you have it is buying high and selling low. And you may say, well, this is absolutely obvious, right? What we're trying to do is buy low and sell high. We're trying to buy an investment for $100 and sell it for $250. Obviously, we're trying to buy low and sell high. So buying high and selling low is, of course, a habit that you should break. But why do people buy high and sell low? Well, it kind of goes back to some of the things we've already talked about, having short-term thinking and then specifically following the herd. Okay, a lot of people who follow the herd end up buying really, really high, meaning that they kind of put, valuation on the back burner. They don't care what the valuation is. If something is hot, right, something is, in favor in the market, they want to be a part of it. And so they don't care how high a price they pay. And what a lot of these individuals end up doing is buying really high, buying at a high price, and then selling when something comes down off of their highs, right, just to cut their losses. And so we really need to get out of this habit of buying things at super high valuations and then being surprised when it goes down in value, and then you try to cut your losses because you really didn't know what you were investing in the first place. You weren't really paying too much attention to the fundamentals of whatever it was, and you end up selling low. Okay, so if you have this habit of buying something at a really high price and then forcing yourself into selling later at a lower price because you didn't do good investment research, then that is something that you need to kind of take heed to and stop doing in your financial life, because that will lose you a lot of money time and time again. Now, I'm not saying that if you pick individual stocks and you have some losers, right, that maybe you don't cut your losers. I'm not saying that is a bad thing. What I'm saying is that in a position where you've done your research and you understand a business and you're going to hold something over a longer term and it just doesn't pan out, and maybe the news cycle doesn't pan out for you, or the company pivots in a way that you didn't expect them to, and you end up selling for a loss, that's not necessarily a bad thing. What's a bad thing is not knowing what you own, buying at a high valuation because you just followed other people into it, and then selling for a loss, and then not really knowing exactly why you sold either. Okay, so that is something that we want to refrain from doing in our investment life. So buying high and selling low is something we do not want to be a part of. Then the sixth investment habit that we need to break is timing the market, because you can't do it well. Right? And it's been proven time and time again that you cannot time the market. Timing the market is a loser's game. All right, you are not going to be able to determine when the market's going to go up and when the market's going to go down, or when a particular stock's going to go up or when a particular stock's going to go down on a reliable basis over a long period of time. You're just not going to be able to do it. And given that that is the case, then we need to focus a lot less on short-term price fluctuations and focus a lot more on long-term value. Okay, that's another reason why long-term thinking and long-term investing is so valuable. Okay, because if you aren't thinking in a long-term way and you're trying to time the market, well, it's very, very likely that you're going to end up taking some losses. But if you think in a long-term manner, then timing the market is never a part of what you're trying to do. You don't have to worry about exactly when to get in and exactly when to get out. What you have to worry about is buying for a reasonable price with a reasonable margin of safety, having an adequate valuation and knowing exactly what something is worth over the long term, and then allowing that thing to appreciate to the value that you think it's worth over the long term. And if the story doesn't change, then stay invested and add some. And then if the story changes, or the valuations just get way too high, or whatever other reason to sell, which I've talked about in the recent past, the reasons that we may sell some asset, right? If one of those reasons to sell pops up, then you sell. But you're not just trying to time the market, buy something when it gets cheap and then sell something as soon as it seems a little overvalued. That's going to allow you to miss out on a lot of returns that you would have otherwise had if you would have just done your research, and if you would have just put timing on the back burner and had a long vision of exactly what your investing life is going to look like. So timing the market, not a good idea, and a habit that you need to break. Then the seventh investment habit that you should break is going to be improper benchmarking. Okay, far too often people benchmark to the wrong indexes. Now, what do I mean? Well, a benchmark is something that you use for comparison. You benchmark maybe your investments to some particular index that you're saying, okay, I want to make at least the returns of these indexes, right? Or of this particular index. Well, if you know that, let's say you hold companies that are large United States companies, and you're investing in individual stocks that are of that particular asset class, of that particular group, then maybe the S&P 500 is something that you should benchmark your investments to. But let's say you invest in a lot of international companies, a lot of tech companies, a lot of smaller companies, right? The S&P 500 may not be something that you need to be indexed to or benchmarked to because the S&P 500 is not indicative of the type of portfolio that you have. That may be something like the NASDAQ, okay, or the Russell 2000 or Russell 3000. All right, so we have to understand that if you are benchmarking to the wrong types of investments or the wrong type of index, then you may be, outperforming your benchmark, but it's not really outperforming the benchmark that you should be setting your investments to. And in a similar way, if you're underperforming a particular benchmark, and this happens quite often, right, it becomes really easy for somebody to talk you into, well, you're not making as much as the S&P 500. Maybe you should change your investments and, be in something that's going to make more or make as much as the S&P 500. Well, somebody's risk tolerance may not be what the S&P 500 offers. If you have somebody who is nearing retirement who's in a 60-40 portfolio and maybe should be in a 60-40 stock bond portfolio, and you're trying to benchmark them to the S&P 500, of course they're not making the returns of the S&P 500 because they have de-risked from that type of investing, okay? And so you have to use a proper 60-40 portfolio to see if the 60-40 that they are in is allowing them some proper returns, okay? So improper benchmarking can be a big issue and something that if you are doing it, you should stop doing immediately. Then the eighth thing that we should not do, the eighth investment habit that we should break is chasing hot asset classes. And I talked a little bit about this earlier, and this really goes with short-term thinking and following the herd. Okay, but if we are chasing hot asset classes, we're likely going to lose. Okay, how many people bought Tesla at the top? Okay, early this year when it was $900 a share. My guess is there were some people, right, or in the upper 800s. And then Tesla's been range bound in the $500, $600 a share area. And, you wonder, am I ever going to get my money back? Am I going to get it back in a reasonable amount of time? Should I just sell and cut my losses? All these types of things just because you bought at a crappy price. You bought when something was hot. Same thing with people buying Bitcoin in the 60,000s, right? That was a hot asset class. And they just bought it up, or even Dogecoin, right? Buying something that was just that hot. Okay, now I'm not saying you should have bought any of these things. I'm just saying that when you are chasing hot asset classes, you're likely to get burned. There's a reason that, when things get really hot, sometimes they have to cool down. And a lot of things have cooled down when it comes to some of the hot asset classes of the recent past. Okay, another hot asset class right now that a lot of people are chasing, and I really, really wonder if it's going to come back to bite them. And my guess is, just because hot asset classes tend to do this, is that it will, and that is real estate, right? A bunch of people are going out and buying homes at ridiculous prices, at ridiculous valuations, when these homes really aren't worth this value, okay? And so they are chasing a hot asset class, and that can always lead you to a place where you're going to be underwhelmed by the returns that you actually receive from the particular asset class that you invest in. So don't chase hot asset classes, and you'll end up buying things at a reasonable valuation, at reasonable prices, and you'll be able to find value in your investments over the long term and not buy them at the top of a particular valuation and then just have to write it down because you invested in something that was just hot at the time. Okay, so that is an investment habit that you should break. Then the ninth investment habit that you should break if you are doing it is overlooking fees. Okay, especially when it comes to mutual fund investing or ETF investing, fees are a big deal. And if you have a financial advisor that you are working with that is helping you to invest your money, that's helping you to get your finances in line, right? If you have somebody that you are working with, then you need to understand the fee structure of them working with you and see if it's really worth the fees that you end up paying them, right? See if the amount that they end up getting of your money every single year is adequate for the work that they're doing. Okay, but when it comes to the expense ratios on mutual funds or ETFs, you need to make sure that those are comparable to the other mutual funds or ETFs, that are of similar type, maybe for different companies, and just see if that's your best bet. Right? It's really interesting that you can find a lot of similar ETFs and mutual funds that do basically the exact same thing, and one costs 0.5% in expense ratio, and the other costs 0.04% in expense ratio, right? So a lot of times those expense ratios will just be indicative of the fact that maybe one is active and one is passive, right? Passive having a lower expense ratio, lower fees associated. And sometimes it's just the fact that those higher expense ratio funds are smaller funds, right? They're just trying to make money with a higher expense ratio. But again, that's not going to be most beneficial to you. You want to keep your fees as low as possible relative to the value created by actually paying those fees, okay? And so if you're overlooking fees, that means you are stepping over returns and you are not getting all the returns that you could be getting in your financial life. So overlooking fees is a habit that you should break. And then if you fail to plan for taxes, you're going to be in trouble, okay? So an investment habit that you should break, the last one that I want to talk about is failing to plan for taxes, okay? So if you're an investor, you should plan for taxes, okay? Whether it be investing in your work 401k where you're going to get a tax deduction, you should understand that that's going to occur. You should understand that you are going to receive a deduction from your taxes for the money that you contributed to your 401k or your traditional IRA. Or if you're investing in Roth assets, right? You're putting money into Roth accounts, Roth 401ks, Roth IRAs. You should understand that, hey, I'm going to pay taxes on this money now, but later on, I'm not going to have to pay any taxes on this money, and the money's going to grow in a tax-free manner. Okay, you should also plan for taxes when it comes to brokerage accounts where you've bought something and maybe sold it for a gain, and maybe you've done it in the short term, or maybe you've done it in a longer term, meaning more than a year, right? If you fail to plan for potential taxes, then it can be problematic because these are a cost to you. And if you fail to plan for particular costs, then these costs can end up being out of hand, and they can end up being something that you weren't expecting, which can put a tax bill at your door when it comes next tax season, okay? So fees and taxes, those last things that you should pay attention to, all right, the last investment habits that you should break, overlooking these things, they're problematic because they are costs that you pay, right? The higher that these costs are, then the lower your net returns are going to be. And we want our net returns to be as high as possible when we are investing, not any lower than they have to be. And so low fees and low taxes will allow our net returns to be very high, and that will be a big part of making sure that you can keep up with your benchmark and keep up with making good returns in your investments over the long term. Now, you may be able to add to this list. There may be more things that you can think of that if you're doing them in your investment life, you need to no longer do these things, or you need to change course and do something different, right? But I think these 10 investment habits that you should break, if you can break these habits, if you're already in these particular behaviors, or then in these particular patterns of action, then if you can break these things, it will be valuable to you. It can help you to create more return in your investment life, and it can take a lot of stress out of the investment process. So let's just recap one more time the 10 investment habits that you should break. It is short-term thinking, herd following, so following what other people do, not sticking to a plan or not having a plan in the first place, relying on past performance, especially of active managers, buying high and selling low, which is quite obvious, but we can be led to do so by valuations. Timing the market, right? So trying to jump in when the market's low and then sell when it goes up. So timing the market. Improper benchmarking, meaning not comparing your investments to the right indexes or the right set of asset classes in the market. So improper benchmarking can be problematic. Chasing hot asset classes, okay, so chasing things that have just gone up in price a ton, right? That can be problematic and can lead to some losses. And then overlooking fees and failing to plan for taxes. Those are the last two investment habits that you should break, because higher costs are going to lead to lower returns, everything equal, okay? So those are investment habits that you should break, and hopefully this helps you to better internalize what you should think about in your investment life, and it can help you to make the highest returns possible and keep the most money that you can from your investments over the long term. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things that I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working towards financial goals that either you have for yourself or that we set for you. Okay, we can begin working towards your financial goals, and then ultimately pushing towards long-term financial freedom and creating a financial life for you and your family that ultimately you could have never dreamed of. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.